and I'm here with Gerald Stack, Head of Investments and Head of the Magellan Infrastructure Strategy. It's been an incredibly interesting 12 months for infrastructure. On the one hand, we've had utilities deliver very predictable earnings over 12 months, as we would expect, unimpacted by the economic environment. On the other hand, we've had airports, of course, in the eye of the storm of the pandemic, as we all understand, and toll roads have recovered relatively quickly. Gerald, can you talk a little bit about the last 12 months and perhaps with a bit of a focus on what's happened this quarter and how you've assessed things?
Yeah, so look, as you said, Matthew, utilities through last year performed at a fundamental level exactly as we would have expected. There's around 80 different utilities we look at, and the overwhelming bulk of them, more than 95% of them met or exceeded their earnings guidance for the year. So companies put out earnings guidance at the start of the year explaining what they're expecting to happen over the course of the year. They all did that ahead of the pandemic. The pandemic then happened to them, and notwithstanding the events of the pandemic, utilities basically all met or exceeded their guidance for the year. That doesn't mean that they didn't have some issues to deal with during the year. People were at home rather than at work, or a lot of the population was at home rather than at work, and therefore commercial and industrial volumes of water, of gas, of electricity were down, but residential volumes were up. Net volumes were down, and they were able to account for that through some cost reductions and working with their regulators. So the thesis very much played out. In the case of infrastructure, a very different kettle of fish. Infrastructure is really transport infrastructure at the end of the day. That is, it's about the transportation of people, goods and data. And in a pandemic where everyone's stuck at home, then clearly anything that's involved in the transportation of people and goods, particularly people, is going to struggle a bit. So we certainly saw that with airports. We certainly saw that with toll roads. Airports, in April last year, passengers were down roughly 94%, according to IATA. By the end of the year, they were down around about 70%, so some sort of recovery, but still down pretty significantly. Traffic, different types of toll roads were down anywhere between 50 to 80%. Again, as individual economies and communities recovered and they were allowed to move around, we saw traffic improve, and then with the second/third waves decline again. But we have certainly seen some early green shoots in the toll road space. When it comes to rail, rail did very well. Rail for us is freight rail in the US. Volumes down again early in the year in sort of April, down 25 to 30%, but recovering through the course of the year, and in fact rail did very well through the course of the year, and rail share prices were up more than 20% on average through the course of the year. Then you have communications data. If ever there was a year where people came to understand the importance of high quality broadband, it was 2020. Volumes of data going through communication networks continued to grow as you'd expect, and the outlook for investment in communication infrastructure, I think, is well understood, and those companies did well through the year. So you see very different things according to what happened through the course of the year. Most recently, in the first quarter of this year, we've seen utilities continue to do what we expect. We've certainly seen, a quarter is a very short period of time, but they've continued to perform as we would expect, providing reliable electric service. No real results at this point in time, but we'd be surprised if we saw anything that surprised us in the financials. With infrastructure, we've sort of seen more of the same. We've seen, as vaccine rollouts have sort of slowed a bit, the progress in general around the world hasn't been as, I think, what people might have hoped. So we've seen volumes sort of stagnate a bit both on toll road traffic generally and also in airports, and therefore share prices being caught up in that a bit. What we have seen during the quarter is very different things happening in January and February versus March. In January and February, there was clearly a concern from investors that inflation would take place late in the year. Not surprising, a expected economic recovery combined with very accommodating fiscal and monetary policy likely to lead to some inflation later in the year. And on the back of that, investors clearly got concerned that rates would rise, and therefore for our universe generally that hurts. We've certainly seen this in the past. We've sort of seen 3 or 4 instances over the last decade where interest rates have risen 1%, and our universe as we define it has typically fallen 5 to 10%. We saw a not dissimilar thematic to that in January and February. In March, we saw some central bankers come out and suggest that yes, that while there may be some inflation, they didn't expect it to be structural. They saw it as cyclical or transient, if you like. And on the back of that, investors came back to infrastructure and in particular to utilities. Utilities, very strong performance through the quarter. So even though it's a very short period of time, we saw a very strong thematic around interest rates, and that's something that we've seen before, and no doubt we'll see it again.
Yeah, it was interesting, wasn't it? At the moment we saw a break in Treasury yields rising, the US utilities really had a very strong rally. So we're seeing market action right there.
Yeah, and this is consistent with what we've seen over, as I said, over the last decade. We certainly haven't seen a lot of instances where interest rates have risen, but we've seen there are 4 particular instances which we've focused on. And as I said, each time rates have gone up by roughly 1%. Infrastructure values, particularly utilities, have come off sort of 5 to 10% different each time. That's typically happened over sort of a 2-month time frame, which is exactly what happened in January, February. And typically then what we've seen is that short-term knee-jerk reaction is overcome, provided that markets settle down a bit. We've seen people come back to acknowledge that these regulated utilities and infrastructure companies generally have got very robust business models that are going to do well through this. They're protected essentially from inflation through regulation, and that as a result those share prices have come back. So that we saw that happen in that first quarter. It wouldn't surprise us if that happened later in the year.
You want to pick up on that inflation point you just made. You know, if we use Warren Buffett, he says the perfect asset to own in an inflationary environment is a toll road, because your revenues go up with inflation, but your fixed capital base really doesn't move. How do you think about the impact of inflation on the overall portfolio?
Yeah, so we think about most things really in terms of the 2 major components of our portfolio, and that is utilities and infrastructure. So utilities providing an essential service, provision of water or electricity or gas, and being a natural monopoly, as a result of those 2 things, they're regulated. And the regulation means that if and when prices go up, you adjust your price. Sorry, even when costs go up or interest rates go up, you adjust your prices so that your return is stable through time. So in the event of inflation, there might be a little bit of timing difference, but we don't expect the fundamental value proposition of utilities, all things being equal, in other words, assuming share prices don't move around, to fundamentally change. On the other hand, infrastructure assets are about the transport of people, goods and data. Their prices are normally linked to inflation. So it's price, not earnings, that gets linked to inflation, and therefore you have protection from inflation. But if inflation is happening because demand is growing strongly, then those assets can earn a high and growing return on capital, and therefore if there are more people going through airports, if there's more traffic going through roads, if there's more data going through communication networks, you get the benefit of that volume kicker, in addition to which you get the protection on the inflation front. So in an inflationary, expansionary environment, infrastructure is probably the place in our world where we want to be more heavily allocated to. In an environment where the economy is more subdued, or indeed you have something of a recession, then potentially really where we want to be is in utilities, subject to price, of course, always subject to price. So different things going on in different sorts of environments, and to the extent that we do see inflation later in the year, and that is essentially our base case, that we will see some inflation. But we expect it to be cyclical and not structural. But in the event that we do see some inflation, and we don't think that it's structural, then to the extent that that leads to share price falls for utilities, you'd probably expect to see us allocate further into that space. That's certainly what played out for us in the first quarter, and that's, I wouldn't quite call it the game plan for the 3rd and 4th quarter of this year, but will certainly be uppermost in our mind through that period.
Just moving to Biden and the US, big announcements about infrastructure spending. Do you see any opportunities in the portfolio with that infrastructure spend?
Yeah, so at the moment that's a plan. It's not, it hasn't been passed, and there's a lot of stuff in that plan, but there are real opportunities in the portfolio. So in the past, what we've seen with politicians announcing infrastructure plans generally as part of an election push is that they've made for good media. But the nature of that infrastructure planning is that it has tended to take a long time, and that it goes beyond a single political cycle. So there's not much a politician can generally do. Where this is a little bit different is that there's clearly a very strong move towards net zero carbon. And generally economies that are moving towards net zero carbon are doing so through a massive increase in renewable energy, a significant increase in electrification of the economy, so a move from internal combustion engine based vehicles to electric vehicles, the use of gas as a source of energy to get us from where we are today to where we need to be in sort of 2050, and the potential use of hydrogen as well. So they're the sort of underlying principles. it's the use, the massive increase in electrification that holds great promise for us, and certainly as part of that plan, the Biden infrastructure plan envisages significant increases in electric transmission to increase the efficiency and effectiveness of the transmission grid across the US, along with continued significant increases in renewable energy through the tax, and encouraging that through the tax credits that are offered to renewable energy producers. Both of those things, investment in the grid and investment in renewable energies, both of those things are positive for the electric utilities that we can invest in. And given that investable electric utilities, private entities rather than public entities, constitute the bulk of the grid, then that's a significant opportunity set for us.
Just broadening your answer a little bit about ESG and sort of more generally the sector, how do you think about ESG? Clearly, there's toll roads allow cars to move more quickly, but then there's an argument that there's the carbon emissions created by the cars themselves, regardless. On the other hand, we see utilities evolving their business models to bring more renewable energy into the grid. How do you see that within your portfolio?
So really any issue, but ESG certainly, we want to look at that through the prism of value. The way that we think about value is the value of any asset, whether it's infrastructure or not, is a function of two variables: the expected future cash flows and the risks associated with those future cash flows. So to the extent that any issue affects either expected future cash flows or the risks associated with it, then we need to allow for that in our analysis of each company or each asset that we're looking at. So we look at ESG on that basis. We look at environmental issues, carbonisation, we look at social issues, we look at governance issues on the basis of how are they affecting either future cash flow generation or the risks associated with that. And we've gone through sort of sector by sector to identify those issues. ESG is clearly a key issue for investors, given the nature of the changes that are going on in the global economy. As I said, the move to net zero, and that's the prism through which we look at it. We've looked at the plan to move to net zero, what are the particular sectors that are going to get affected by that, what are the particular assets, and it will differ from jurisdiction to jurisdiction. For example, a gas distribution asset, a gas distribution network, in some communities, in communities that suffer extremely cold winters, sort of minus 30, minus 40 winters, you're not about to replace that gas heating network very quickly. However, in a more temperate climate, then it's eminently plausible that you would replace gas heating with electric heating, with electric heat pumps. So you need to think about that on an asset by asset, a domicile by domicile basis to understand what are the impacts on future cash flows and the risks associated with those cash flows. Government policy is clearly a big part of the risk equation. So certain governments in certain jurisdictions are clearly heading down a very green path. We need to take that into account. In other jurisdictions, particularly as I said, where there are environmental factors that mean that it's not necessarily safe, as it were, to go to electric just yet, it's going to take a little bit longer. So we bring that to bear.
Swing over to debt a bit. I mean, interest rates across the world are incredibly low. It's made borrowing more attractive for individuals, for companies of all types, but particularly for the types of companies we like to invest in this strategy that have incredibly robust cash flows. So no doubt the borrowing rates available to them are incredibly attractive. Have you seen any evidence that they're taking their borrowing levels to a level which you'd feel uncomfortable with or are reasonably relaxed?
Yeah, look, we've certainly seen a lot of refinancing happen, not just over the quarter, but really over the last, I would say, 5 years. But we're not seeing fundamentally significant increases in the underlying level of leverage that we've been able to identify anyway. We see no signs of debt distress in assets that are operating under normal circumstances. Airports we might just put to one side. We can come back to that if need be. But generally we're seeing levels of underlying leverage of gearing that are in line with historical precedent. What they are taking advantage of, what companies are taking advantage of again over the last 5 years, is the fact that rates are low and that they can access those low rates for long duration. So we're seeing the average duration of the debt book grow over time. That is, essentially the companies are locking in a larger and larger share of their interest costs at current rates for long periods of time into the future. Now, if you are a believer that inflation is going to present and that interest rates are going to rise, that will mean these companies have a real benefit for, well into the future. The average debt maturity in our portfolio today is something north of 10 years on our last piece of analysis. So, they're locking in their debt for long periods of time into the future, and that's been the big benefit. Clearly, I mentioned airports. Clearly, airports are in a time of distress just at the moment, and they've had to raise, or a number of them have gone to the effort to raise additional capital. The good thing for those guys is that the banks are continuing to lend to them at very cheap rates, again for long duration. So it's clear that the credit markets are not unduly concerned by the situation that airports currently face. If it was, if the current set of circumstances was to prevail for the next decade, then that would be a different kettle of fish. But I think it's broadly expected by the airports, by the airlines, by the banks, by all stakeholders in this, that people will be flying again, they will be travelling again. It's just a question of when.
Thanks, Gerald. I just wanted to finish up. If you give anybody advice at the moment, what would you say to them as a portfolio manager?
I think there's a couple of things. First of all, have a strategy. Understand what you're seeking to achieve, what's your objective and how you're going to go about it. And then be patient with that strategy. Don't trade because the strategy is not working for you on a given day. Have a strategy that's a long-term strategy. Be patient and stick with it over time.
Thanks, Gerald.
Thanks, Matthew.
And thanks everybody for joining us. We hope you found Gerald's insights and thoughts helpful in your everyday investing. We very much appreciate your time, and if you have any questions, please don't hesitate to contact us at Magellan. Thank you.